Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio, not by chasing hype, but by stress testing it. Today, we are putting ROST stores on the anvil. They just dropped a Q4 earnings report that, on the surface, looks like it was machined from a solid block of steel. I'm talking surging sales, skyrocketing earnings, and rock-solid guidance. On paper, this thing is a beast. But you and I both know that in this market, you cannot take the headlines at face value. You have to hammer on that metal. You have to see if it rings true or if it's just a polished surface hiding some serious weakness underneath. We're here to find the cracks.
That's exactly right. The numbers almost look too good. When every headline is screaming, beat, 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 that's precisely when our alarms should be going off. That's when we need to be the most suspicious. So our job today is simple. We are going to stress test this foundation. Is ROST a true retail fortress? A company that can actually weather an economic storm? Or is it just a gilded facade, all shiny and impressive on the outside, but ready to crumble the moment any real pressure is applied? It's time to cut through the noise and get a good look at the actual blueprints.
Okay, let's dive right into it. We always start with the hard numbers, the bottom line, because that's what really matters. Earnings per share of $2. Now the street, all those Wall Street analysts, they were looking for $1.88. That's a solid 12-cent beat. Look, in the world of retail where your margins are razor thin and managing expectations is everything, that's not just a small win, that is heavy-duty performance. It tells you that this company isn't just moving products off the shelves, it's efficiently converting every single one of those sales into pure, hard profit for its shareholders. This is the first major pillar of their report, and I have to say, it looks incredibly strong. Okay, I'll give them that. A $250 million beat on revenue is impressive. Nobody can deny that. But here's the question I always ask, the one you should always be asking. Where did that growth come from, and more importantly, is it built to last? A single blowout quarter, especially one that lands during the holiday shopping season, could easily be a fluke. It could be driven by insane, deep discounts that completely destroy your margins in the process. We can't just stand here and admire the headline number. We have to get into the blueprints and see how they actually constructed this thing. All right, here's our plan of attack for today. First, we are going to test that sales engine. That's the top line that powers this entire operation. Second, we're going to fire up the Forge and really analyze their profitability. Third, we will inspect the balance sheet fortress, looking for any and all structural weaknesses. Fourth, we'll scrutinize their 2026 growth blueprint to see where they think they're headed. And finally, we will deliver the iron financial verdict. Is ROST a cornerstone for your portfolio, or is it a carefully laid trap? Let's get to work. First up, the top line. Sales are the main load-bearing walls of any retail company. They have to support the entire structure. We're talking costs, payroll, marketing, expansion, every single thing. If these walls are weak, or if they're built with cheap materials, the whole building is at risk of collapse. So let's apply some serious pressure and see how much weight these walls can actually handle. We need to figure out right now if this growth is just cosmetic or if it's truly structural.
Look at this structure right here. Just take it in. Total sales for the full fiscal year climbed from $21.1 billion to a record-breaking $22.8 billion. That's a healthy 8% increase year over year. That is solid, consistent construction. But the real story, the part that's really making the market sit up and take notice, is buried deeper, inside the quarterly performance. You see, full-year numbers are great for giving us context, but the fourth quarter, that tells us about momentum. And momentum is what drives stock prices higher.
And this, right here, is the critical number, 9% comparable store sales growth. Now, for anyone new to this, comp sales is probably the single most important metric in all of retail. It strips out any growth that comes from just opening new stores and tells you how the core business is performing. It measures sales at stores that have been open for at least a year. A 9% gain is absolutely massive. It shows this isn't just about expansion, this is about their existing operations firing on all cylinders. It demonstrates powerful organic customer demand. Real people are walking into the same old ROST stores and spending more money. That is the undeniable sign of a healthy engine.
Okay, compelling merchandise. That's what every single retail CEO on the planet says after a good quarter. Let's be real here. This was the holiday season. Of course, consumer spending was high. The real question, the billion-dollar question, is whether this was just a sugar rush from some one-time marketing blitz and holiday bonuses, or if this is actually a sustainable trend that's going to carry through into the new year. Answering that question is what separates a good trade from a disastrous long-term investment.
All right, let's shift gears. We've talked about what they sell, now let's talk about what they actually keep. There's an old saying on Wall Street, sales are vanity, profit is sanity. A lot of companies, a lot of them, can grow sales by just slashing prices to the bone, but it absolutely kills their margins. We need to see if ROST is actually forging real, durable profits from all that top-line heat. So, it's time. Let's fire up the profit forge and see what kind of steel comes out.
The numbers here on the income statement, well, they speak for themselves. This is a clean year-over-year comparison. Sales are up significantly, you can see that, from $5.9 billion to $6.6 billion. But look at what follows that top line. Operating income, that's the profit before you account for interest and taxes, is up from $731 million to $814 million. And net earnings, the final take-home profit for shareholders, is up from $587 million to $646 million. Every critical profitability metric shows a year-over-year strengthening. They aren't just selling more stuff, they are earning more on every single level. This is what we call operational leverage in action, and it's beautiful to see. And here is the proof of their operational excellence. This is what really impresses me. Management went to Wall Street, to all the analysts and investors, and they said, we are aiming for an operating margin somewhere between 11.5 and 11.8%. That was their promise. But they didn't just meet that promise. They shattered it, landing at a stellar 12.3%. Now, this is not an accident. This is discipline. This means they manage their costs, everything from inventory and staffing to logistics and shipping, with extreme precision, even while they were handling a massive surge in sales. This is the mark of a management team that has a firm, confident grip on the controls of their business.
Okay, I'll grant you that. Strong sales and profits, they're like the impressive tall towers of a castle. They're what everyone sees, but they mean absolutely nothing if they're built on a weak foundation. So now we have to do our due diligence and go inspect the balance sheet. This is where a company's true financial health is revealed, warts and all. We're looking for strength, sure, but more importantly, we're checking that foundation for any potential cracks that could threaten the entire structure down the road.
Management is signaling extreme confidence with this move. They just authorized a new 2-year, $2.55 billion stock buyback program. That's a huge 21% increase over their last authorization. Let's be perfectly clear about what this means. The company itself believes its own stock is a fantastic investment. They're taking their hard-earned profits and using them to buy up their own shares on the open market. That reduces the number of shares out there, which in turn increases earnings per share for all the remaining investors. You simply do not authorize a multi-billion-dollar buyback if you think your company is built on shaky ground. Period.
And for all you income-focused investors out there, here's even more concrete evidence of their financial strength. A 10% hike in the quarterly cash dividend, up to 44.5 cents per share. Again, this isn't just some promise of future performance. It's a cold, hard cash commitment. Raising a dividend is an incredibly powerful signal to the market. It tells shareholders that management is confident not just about their past performance, but about their ability to generate consistent cash flow long into the future. This is exactly what a company with a rock-solid, predictable cash flow does. They reward their long-term owners.
And here it is. This is the bedrock of that entire foundation. They are sitting on a fortress of cash, nearly $4.6 billion in cash and cash equivalents. In today's volatile macroeconomic environment, let me tell you, cash is king. This mountain of liquidity gives them immense flexibility. They can weather practically any economic storm, they can pounce on opportunities like buying up distressed inventory from their failing competitors, and they can fund their own growth without having to take on excessive, dangerous debt. This is a massive strategic advantage. Okay, hold on. Just hold on a second. A huge buyback, a big dividend hike, a literal mountain of cash. It's a perfect story. Almost too perfect. Which brings us to the single biggest, most glaring question you have to ask when you see a picture this rosy. If the fortress is so strong, why are the insiders, the generals who are actually inside the walls, selling their stock? That's not some small detail you can just brush aside. That's a 5-alarm fire drill. And we need to investigate it right now. And here are the cracks. Data from Guru Focus shows there have been 10 insider sell transactions over the past year, and 0 insider buys. The people with the most information, the ones who know the business inside and out, are choosing to sell, not buy. At the exact same time, the stock's valuation metrics are stretched thin. A price-to-earnings ratio of nearly 31 and a price-to-sales ratio near 3 are both sitting at or near 3-year highs. That means the stock is, historically speaking, very expensive. And finally, look at their inventory. It's creeping up,
from $2.44 billion last year to $2.63 billion now. In retail, inventory is like food in a kitchen. It has to keep moving or it spoils. Rising inventory can mean one of two things. Either they're betting big on future demand or they're having trouble selling what they already have. These are the hairline fractures that we need to be watching very, very closely.
All right, let's look ahead. Past performance is one thing, but the market is a forward-looking machine. It invests based on what it thinks will happen in the future. So it's time to examine the blueprint for fiscal 2026. Management has laid out their guidance in the earnings release, which gives us a roadmap for the year ahead. We need to analyze this plan carefully and determine whether it's ambitious, realistic, or just a bunch of wishful thinking.
The guidance they've laid out is strong. There is absolutely no question about that. For the first quarter, they're projecting that incredible comp sales momentum to continue, forecasting growth of 7% to 8%. That, they say, would translate to earnings per share between $1.60 and $1.67. For the full year, they expect things to normalize a little bit, but they're still guiding for a solid 3% to 4% comp sales growth and full-year EPS somewhere between $7.02 and $7.36. This is not the guidance of a company that's bracing for a downturn. This is a confident blueprint for sustained, profitable growth.
You know, the CEO's statement here is exactly what you would expect to hear. It's boilerplate confidence. He's talking about a healthy balance sheet, disciplined execution, and sustainable, profitable growth. It all sounds great. But every single blueprint comes with a section on risks, a list of all the things that could go horribly wrong during construction. And if you take the time to read the fine print in Ross's own 8K filing, their risk section is a very, very long one.
That's right. Their own government filing lists a minefield of risks that they have little to no control over. We're talking about the macroeconomic environment, continuing inflation, potential tariff increases from overseas, supply chain disruptions, huge uncertainty in U.S. trade policy, and sudden, unexpected shifts in consumer spending. And that's before you even get to the brutally intense competitive pressure in the off-price retail sector. The blueprint looks fantastic in a perfect world, but the construction site, the real-world economy, is messy, it's unpredictable. Any one of these external factors could completely derail their plans. So, we've done it. We've torn down the report. We have hammered on the sales engine. We've fired up the profit forge, and we have inspected every single beam and pillar of that balance sheet. We've read the blueprints, and we've read the warnings. So now it is time for the final verdict. Based on everything we've seen here today, is this company a cornerstone that you can confidently build a portfolio around, or is it a structure that's just too risky to even enter right now?
So here it is, the bull case, and it is forged in iron. You have the massive Q4 earnings and revenue beats. You have that powerhouse 9% comp sales growth. They smashed their own operating margin guidance, showing incredible discipline. And they are rewarding shareholders with a massive $2.55 billion buyback and a 10% dividend hike, all of it backed by very strong 2026 guidance. This is a best-in-class operator that is firing on all cylinders. But the bear case sees some very serious cracks in that armor. It asks if that 9% growth is just a holiday hangover that's about to fade. It points directly to those 10 insider sell transactions as a screaming red flag. It highlights a nosebleed valuation with PE and PS ratios at 3-year highs. And it sees rising inventory and a sea of macroeconomic risks that management simply cannot control. This could be a classic value trap, where all the good news is already priced into the stock, and then some.
Ultimately, the numbers in this report show a company with tremendous operational momentum and a balance sheet that is undeniably forged in iron. The execution is there, you can't argue with it. But the market context, the stretched valuation, and those very loud warning signs from the insiders, they all demand extreme vigilance. So the final question for your portfolio is this: do you bet on the beautiful, perfect blueprint, or do you hedge against the very real cracks in the foundation? That's the decision that you have to make. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.